This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, we're still on transfer pricing, which is chapter 18 of the free lecture notes for F5. And in the previous lecture, I explained what we meant by the transfer price, why do we have a transfer price, what we mean by cost plus transfer pricing, but finally, why there can be a problem, however we fix the transfer price, if we're not careful, there can be a problem that we make non-goal congruent decisions, that managers, there's a risk they make decisions which are not good for the company. And so in this lecture, I want to go through what I call sensible transfer pricing, how we should fix the transfer price to make sure that managers are motivated to do what's good for the company as a whole. And although ultimately I'll write down a rule, this is one place where really it's important you understand what's happening. And it's not purely learning a rule. And so we'll go through a series of examples, and I think you'll see how the rule itself builds up. And so let me show you what I mean. Can you turn now to example 4, which in fact is exactly the same example as the one I did in the last lecture, example 3, but this time we're going to fix a sensible transfer price. So example 4, division A, same basis as all those we've looked at. Division A has costs of 20 per unit. They transfer goods to division B, and it's got extra costs of 8 a unit, and B sells externally to outside customers at, what is it, 30 a unit. And so, of course, the company as a whole, total costs of 28, selling for 30. The company's making a profit of $2. They want this product to be produced. Our job is to decide on a sensible transfer price that motivates both managers to want to produce it. And we look at the two separately. First of all, manager A, we say, what will the transfer price have to be for A to be prepared to produce and sell it to B? Well, surely, since they've got costs of 20, they'll be motivated to produce, provided they can sell it to B for anything more than 20. And so A, the transferring division, they fix the minimum transfer price. And the transfer price, as I said, since they've got costs of 20, they need to be able to charge more than 20 for them to be prepared to produce. And so the transfer price we end up with must be more than 20. Now, if rank's more than 20, A is motivated. What about B? B's the person who's buying it. And so B determines the maximum they're prepared to pay. And we say, well, what's the most that they'll be prepared to pay if they're going to be profitable and therefore to want to buy it? Well, surely they're going to sell it at 30. They've got their own costs of 8, which leaves them with a net 22. Surely they'll only be prepared to buy it from A, provided they can buy it at less than $22. The transfer price will have to be less than 22. It's the 30 that they're selling at externally. They've got their own costs of 8. And therefore, to end up with a profit, they'll have to be buying it for less than 22. And so the transfer price will have to be in the range 20 to 22. And here you see it's rarely a question of coming up with a fixed transfer price. It's a range. Whatever transfer price we end up with, it must be somewhere between 20 and 22. You know, let the managers argue between themselves if you want. But anything between 20 and 22, A will be motivated to produce, B will be motivated to buy. The product will be produced, and that's automatically good for the company as a whole. Some people get very annoyed at putting 20 to 22. You know, if the transfer price is 20, A makes no profit, perhaps they're not motivated. But, you know, even if it's $20.01, it's profitable for A will be motivated, but that's not how we write it. So it's a sensible transfer price, it's a range. Just a bit of terminology, even though in the exam it's the figures themselves, the numbers that matter. Division A fixed the minimum transfer price, and to be prepared to cite it must be more than cost. That 20 is the marginal cost. Marginal variable cost. Now the point is, Division A will presumably have fixed costs as well, but I did say in the previous lecture, we always assume that this is just one product, but we're actually making lots of different products. And so whatever fixed costs there are in Division A, they'll still be there whether we make this product as well or whether we don't. So if the fixed costs are already there and aren't going to change, the only extra cost of making this product is the variable or marginal cost. As far as B is concerned, you saw how I got the 22. It's the revenue they're going to get of 30 less their own marginal costs. And so we call that 22 the net marginal revenue. So I said before, the terminology itself isn't desperately important, but that's what we call them. The main thing, obviously, is getting the figures. All right, so that's what we talk about with sensible transfer pricing, motivating the managers, both of them, to do what's good for the company. To build up the rule, let me go through a few more examples, making it slightly more interesting. Have a look at example 5 now with me. Or I brought in a little bit more. Example 5, Division A has costs of 15 per unit. They transferred goods to Division B, which has extra costs of 10. Division B sells externally at 35. So far, just like the previous ones with different numbers. But there's a bit extra here. Division A can sell these part finish units externally. So they can sell the units to B, and they're part finished because B then has to do more work on them. Or instead of selling them to B, they can sell them externally. But because they are going to need some extra work done on them, they can sell externally, not at 35, at a lower price. They can sell externally for 20. And incidentally, if they can sell it externally, sometimes you see this called an intermediate market. But also, read that last sentence there, which is critical to what follows. There is limited demand externally from A, and A has unlimited production capacity. So A is capable of producing as many as we want. They can sell on this intermediate market, they can sell externally, but there's a limit how many they can sell. The limit doesn't matter. Maybe we could only sell 1,000 units externally. Maybe it's 5,000, but there is a limit. A is actually capable of producing as many as we want. Well, what's going to happen? Remember, what we want to know, A can supply the goods to B, obviously, but we need to know a sensible transfer price. We need to know the minimum. Let's look at A first. What's the minimum price at which they're prepared to sell to B? Well, I don't know, maybe you came up with an idea instantly, but think about it. A is happy to sell externally, obviously. They make $5, they report $5 a unit profit. And profit's worth having. And so fine, sell externally, however many the external one wants. But whether externally they only demand 1,000 or they demand 5,000, again, sell them what they want to make $5 a unit profit. But A is capable of carrying on producing lots more. They can't sell any more externally, there's a limit, but they can produce more and supply them to B. And what's the minimum price at which it's worth supplying to B? Surely anything more than 15. As long as B pays more than 15, they're already making a profit of $5 on those they're selling externally, but that is limited. All right, we can produce more. And I'll produce more as long as I can sell them at a profit, but the only person who'll buy them is B. And provided B pays more than 15, then fine. You're still getting your $5 a unit on those sold externally. Get as much profit as we can from those sold to B. But as long as it's more than 15, it is worth selling to B. What about B, who fixes the maximum price? Just as before, the most they'll be prepared to pay is this net marginal revenue. They're selling at 35, they've got their own costs of 10. The most they'll be prepared to pay is 25. And so a sensible transfer price must be in the range 15 to 25. And as long as it is, A is motivated to sell to B, B is motivated to buy from A. And it turns out here, because of the wording, that the external 20 business is irrelevant. It's because there's limited demand externally. Sell them what they want. Is it worth producing more? Yes. They can only be sold to B, but it's worth producing more to B, as long as they pay more than 15. In the exam, they can ask similar things, but put numbers to it. For instance, and I'm making up numbers here, suppose I told you that A has production capacity of 20,000. A has external demand for, let's say, 5,000, and B wants 10,000. Well, what's going to happen? There's external demand for 5,000, and that's profitable. They make $5 a unit. So A will sell externally 5,000 units. In addition, B wants 10,000. Well, A's got plenty of production capacity left, and so they'll also transfer to B the 10,000 they want, provided the transfer price gives them a profit, provided the transfer price was within that range. It was more than 15. And therefore, A will produce 15,000. They're capable of producing 20, but obviously there's no point in producing more than we can actually sell. However, the real thing here was the transfer price. I think I've said enough. Look now at example 6. It looks identical, as you'll see, but there's one change in wording which is critical. A has costs of 15 a unit. They transfer to B, which has its own costs of $10 a unit, and B sells externally for 35. Again, A can sell in the intermediate market. They can sell the part finished goods externally because they're part finished. They can only sell them at 20. So exactly the same as the previous question, except the next sentence. There is unlimited external demand from A, and A has limited production capacity. So maybe A can only make a total of 10,000 units. There's a limit on how many they can make. There's unlimited demand externally, so they could sell everything they produced externally. Now again, you may have already spotted the answer, but think it through and make sure. If it wasn't for B wanting some, then of course we would sell externally everything we produced, and we'd be making $5 a unit profit. B wants some, but remember, we could sell all our production externally, and so for every unit we supply to B, it means one less unit can be supplied externally. And if we sell one less unit externally, we're losing $5 profit. Fine, we'll bear to sell to B, but B's got to give us at least $5 profit as well. We're only going to sell to B, provided they pay at least 20. Otherwise, why should we sell to B? We can sell everything we produce externally for 20. If I sell to B, we can't sell as many externally. And so B's going to have to give me at least 20 as well. A, as always, fixes the minimum transfer price. And although the answer is 20, and for this question, if you write 20 straight down, that's it. For reasons that you'll see later, the transfer price, well, to sell to anybody, they're going to have to charge more than marginal cost at 15. They'll never sell to anybody at less than 15. Here, because there's limited production capacity, every unit sold to B loses us profit, or strictly contribution that we could have made externally. And since each unit could generate $5 contribution, selling to B, they're going to have to give us that $5, the lost contribution. And so the transfer price will have to be at least 20. Now, I hope that makes sense. You'll see later why I wrote marginal cost plus lost contribution, because there are little tricks that can come later. But do appreciate the difference between 5 and 6. The reason we needed that, we've got that lost contribution, and what you're looking for always is when there's a limited production capacity. As soon as you see any mention of limits on production, then potentially you've got this problem. So that's the minimum. The maximum is fixed by the buying division, B. And same as before, the most they'll pay is the net marginal revenue, 35 minus their own costs of 10, 25. And so, for example, which was 6, the transfer price has to be in the range. What was it? 20? Yeah, 20 to 25. If it is, A is motivated to produce and sell to B. B is motivated to buy from A because they'll both be reporting a profit. And is that good for the company as a whole? A could have sold all their production externally, and if they did, the company as a whole would be making $5 a unit profit. Alternatively, if it's the right transfer price, A could sell everything to B, and B sells externally. And how much then would the company be making? Total cost 25, external selling price 35, $10. So the company prefers A to sell to B to sell externally. That's what they want them to do. And provided the transfer price is between 20 and 25, A is motivated to sell to B, B is motivated to buy. All right, one more, and then I'll give you the rule. Number 7. Division A has costs of 8. They transfer to Division B, which has its own costs of 4, and they sell externally at 20. Determine a sensible range for the transfer price in order to achieve congruence if Division B can buy part finished goods externally. So this time it's B who has the choice. They can buy goods from A as normal, or alternatively, they can buy the part finished goods externally. And in fact, 7 is 2 separate questions. They can buy part finished goods externally. Let's look what happens, A, if they can buy outside at 14. So there we are. And the question again is, what's a sensible range for the transfer price? Again, look at the 2 divisions separately. Division A fixes the minimum. And there's no production limitation or anything here, and so they're prepared to sell to B, provided they get at least $8 a unit. What about B? B fixes the maximum transfer price, the most they're prepared to pay. And of course, they'll never be prepared to pay anybody more than net marginal revenue, otherwise it's not profitable. The net marginal revenue, they're selling for 20, their own costs of 4. The net marginal revenue is 16, so they won't pay anybody more than 16, clearly. They can buy, though, for 14, which is fine. It'll be profitable. They can buy externally for 14. And so what are they going to do? Buying externally will make them a profit. They can buy from A, but of course, they're not going to pay A more than 14. If A was charging 15, it may be profitable, but they make more profit by buying externally. So in fact here, the net marginal revenue is irrelevant. The maximum transfer price is going to be 14. If A charges more than 14, B would prefer to buy externally. And so the range will be 8 to 14. If the transfer price is in that range, A is motivated to produce and sell to B. B would prefer to buy from A rather than buy externally. And is that good for the company? The company, if A does produce and sell to B, the costs are 12, sell for 20, the company would make $8 overall. On the other hand, if the transfer price was too high and B preferred to buy externally, then the cost to the company would be 18, sell for 20, it'd only be 2. So the company wants B to buy from A, provided the transfer price is less than 14, B will buy from A. Finally, though still on example 7, I said there were 2 questions. Part B is exactly the same, except the external price is 18. Otherwise, exactly the same. Let's do it again. The minimum transfer price, again, will be $8. A is prepared to sell to B, provided they get more than the cost. What about B? B will never pay anybody more than the net marginal revenue, which was 16. Their net marginal revenue, 20 less 4 is 16. They won't buy it from anybody at a price of more than 16. And so, although they could buy externally for 18 this time, of course, they certainly won't buy externally, otherwise B would be loss-making. So they won't buy externally, they will buy from A, but of course they're not prepared to pay more than 16. And so the transfer price would then have to be 8 to 16. Anything between 8 and 16, A would be motivated to produce, B would be motivated to buy, and to buy from A as opposed to external. All right, well, I hope you're happy with the logic of each of those. I could go on all day, do another 10 examples. But those, what I've been trying to do is build up the rule, because although there is a rule which I'm about to write down, I've learned the rule certainly for multiple choice questions. Any multiple choice question is likely to be just blindly applying the rule. But make sure you do see the logic behind it, because in section C questions, the examiner is clever. The arithmetic doesn't get any harder, but there'll be, a lot of wording to sort out. And the examiner's trying to find ways of checking that you do understand what's happening, that you understand the logic, and it's not purely that you've learnt a rule. However, over the page, I've left space. And as a result of what we've been doing, I hope you agree that, first of all, the minimum transfer price, it's fixed by the transferring division, which in all my examples was A, the one that's doing the transferring. And it's always the marginal cost, the variable costs of production, plus any lost contribution. If you look back, examples 4 and 5, there was no lost contribution, so it was simply marginal cost. But lost contribution will potentially occur when there's limited production capacity. The minute you see there's limited production capacity, then you're looking to see, could they have sold externally instead? In which case you've got this lost contribution. All right, that's the minimum. The maximum transfer price is fixed by the receiving division, which in all my examples was B, but obviously they're what we called A and B in the exam. And the minimum transfer price, and look back to example 7 if you need to check you agree, it's always the lower of, firstly, the net marginal revenue, Division B will never pay more than net marginal revenue to anybody, otherwise they're loss making. It's the lower of that and any external purchase price or purchase cost. They're provided they can buy externally at less than the net marginal revenue, then that's the most they'll pay the other division. It's always the lower of the two. So there is the rule. And I say again, learn the rule in a multiple choice. You probably only just a blind application of the rule, understanding and not understanding. But please make sure you're happy where it came from, that you are clear about examples 4, 5, 6 and 7. I've already said why. All right, that's it. However, there's one more example there, which is quite a clever little one. I'm going to stop this lecture here. And I can't force you, but I really do suggest you have a look at example 8 and think very, very carefully and see if you can come up with an answer. But in the next lecture, I'll go through it. You can check whether you're right or not, and I'll explain the logic. So one more lecture, but that's going through example 8.